What will kill the emerging market rally? By www.forexconspiracyreport.com. It was a relentless pursuit of leverage in investing and trading that led up to the 2008 market crash and Great Recession. And it is leverage in China by those used to easy millions that in the end will kill their economy and kill the emerging market rally. Bloomberg looks at these factors as they affect the emerging market rally. A drop in oil prices and China's crackdown on leverage, spurring this month's rout in industrial metals and iron ore, is setting the stage for a correction in developing country assets, according to a growing chorus of investors and analysts. While still in the minority, they warn a tide of capital inflows and a jump of bullish positions have left valuations at an inflated level after gains in emerging market stocks, bonds, and currencies this year. Global markets have largely shrugged off Beijing's move to tighten the credit spigot, which has sparked a rout in domestic stocks and bonds, driven by sanguine projections over the outlook for China's output, exchange rate, and capital account. China's 10-year government bond yield will peak at 3.8% by the end of June, before moderating, according to a Bloomberg survey. But bears say that investors are discounting the risk that the reduction in leverage will slow growth in other developing nations as well. The article says to sell from highs now in equities and currencies, as the downside when the commodity and stock rally breaks will be impressive. The resource curse. Our sister site, Profitable Investing Tips, wrote to beware the resource curse of commodity boom and bust cycles when investing or trading currencies. Brazil rode high during its commodity boom and has been licking its wounds ever since. Venezuela bought friends in the Caribbean with discounted oil, and now its citizens cannot find milk, diapers, or toilet paper in the stores. Beware of the resource curse or boom and bust cycles in commodity-dependent economies. Perhaps you have engaged in foreign direct investment in countries like Mongolia, Brazil, Russia, or Saudi Arabia, or have bought into stocks of companies that invest in these places. If that is the case, you need to beware of what the economists call the resource curse of boom and bust cycles. Mongolia, like other resource-rich countries, rode the Chinese economic boom to the top and then started to use their cash flow to get or issue credit to build too fast and siphon off their riches just as the riches were on the downturn. What will kill the emerging market rally will be China cutting back as it attempts to rein in debt and avoid an economic hard landing. Economies across the globe that have profited from the boom years as China grew will need to become accustomed to slower growth, lower prices, and excessive debt. Forex traders need to be wary when trading currencies in emerging markets. There is always a bull market somewhere, but in the near future it will not be China or its circle of commodity suppliers. For more insights and useful information about Forex markets and trading, visit www.forexconspiracyreport.com.